Okay, I'm Jacob Hornberger, president of the Future of Freedom Foundation, and welcome to the next presentation in our online conference, End Inflation and the Fed. Great to be back with y'all. I got to say, we got another great presentation. We're getting close to the end here. We've got our speaker this evening, and then we got Ron Paul next week, and then we wrap everything up with my presentation after that. For those of you that are new to FFF, come and visit us at fff.org for around 33 years of principled arguments, articles, speeches, conferences, and presentations and podcasts on the principal case for libertarianism. In fact, this is our fundraising time of the year. We just posted our end of year fundraising letter on our website at fff.org today. Hope you all take a look at it, and I hope you'll consider making a generous donation. Without those of you that help us out in a bigger way, we can never do conferences like this and the other things that we do to advance liberty. So I hope you'll give that your best consideration. Also, if you have a question tonight, be sure to use the Q&A button, not the chat button, and type that in there, and then I'll read it at the end. So we're really honored to have another great presenter this evening. Some of you may have recalled that our speaker tonight, Robert Wright, recently wrote an article for FFF called Fed Up with the Fed. And so he fits in perfectly with our conference. He is a senior research fellow at the American Institute for Economic Research, AIER. He's the author or co-editor of over 24 major books, book series, and edited collections, including AIER's The Best of Thomas Paine and Financial Exclusion. He's also co-authored numerous articles for such journals as the American Economic Review, Business History Review, Independent Review, Journal of Private Enterprise, Review of Finance, and Southern Economic Review. He's taught business, economics, and policy courses at Augustana University, New York University, Stern School of Business, Temple University, and the University of Virginia and elsewhere. He got his Ph.D. in history from State University of New York at Buffalo in 1997. Robert, thank you for joining us. It's a great honor and a pleasure to have you be with us.
Oh, it's a great honor being here. So the lineup of folks that you've put together, and I can hardly wait to hear what Ron Paul is going to say next Monday night. But tonight is my night, and I have a presentation, so I'm going to share it right now, if all goes well. Is that working?
No, oh, here it comes.
All right, so I chose this particular template because the title there, the federal constitution, the Constitution of the Fed, appears to be in a tombstone. And it looks like there's some sort of explosion going on or something. So I thought that that fit the theme quite well. The thesis for tonight is that the Federal Reserve is unnecessary and improper. And of course, this is a play on the necessary and proper clause in the US Constitution. I'm going to try to make 4 major points, and I'll unpack each of these. Now, this is just sort of the outline or the plan for my talk tonight. So the Fed is unnecessary in that the central bank, or a central bank, is not in the US federal constitution, and it's not in our informal or unwritten or expectational constitution either. And it's not part of America's fiscal constitution, which Richard Ebling described in the talk that launched this conference. The second reason that the Fed is unnecessary is that Alexander Hamilton's argument in favor of the constitutionality of the Bank of the United States is inapplicable to the Fed for reasons I'll detail later. The Federal Reserve is improper because the monetary system need not privilege domestic monetary policy discretion over international capital mobility or fixed exchange rates. There are other solutions to what macroeconomists call the trilemma. And again, I'll detail those later. The fourth point, or the second reason why the Federal Reserve is improper, is that private lenders of last resort are not only possible, but they're more likely to implement what you may know as Bagehot's rule, but what I and some other financial historians have taken to call Hamilton's rule, rather than the more destructive and redistributive types of bailouts that are favored by the Fed and the US Treasury. So the first point, no central bank mentioned in the written US Constitution. Now, I'm not arguing that the Federal Reserve is unconstitutional. That might be the case, but that is a much more difficult case to make than I have time to get into, here. The point that I want to make is that the Fed, unlike, say, the Supreme Court of the US, can be eliminated merely by the passage of a law. We don't need to amend the Constitution to get rid of the Fed. A simple law, passed by both houses of Congress, signed by the president, could completely get rid of it. And this would apply to the Supreme Court, it could be dramatically altered just through statute. So again, it would just require Congress and the president's a signature, and we could have a very different institution in place, or again, none at all. Now, its lack of constitutional standing, so to speak, is great for those of us who would like to end the Fed, to get rid of it. But until that occurs, its lack of constitutional standing is very problematic, because it means that the Fed doesn't have significant independence from political pressures, like those that Phil Magnus, my boss in an earlier conferee, outlined a few weeks ago. And of course, the more political pressure that can be put on a central bank like the Fed, the less price level stability. So the more variance in changes in the price level, and also the higher average inflation over time. This is a chart from a famous textbook that I used to use when I taught money and banking at the University of Virginia. And you see in at the top of the vertical scale, this measures the average inflation rate from 1973 to 1988. And then the horizontal scale purports to measure the degree of independence that a central bank has from its from their respective national governments. And the lesson that was supposed to be drawn from this is that the more independent a central bank, the lower the average inflation rate over that time period. The idea was we want to make central banks more and more independent from political pressures, and that will lead to greater price stability as measured by the average inflation rate over time. And you can see certainly the way this is drawn, there does seem to be a strong correlation. Of course, this horizontal scale is a bit hinky in index of central bank independence. It's not like if you go to the Board of Governors building or any of the district Federal Reserve banks, and you see an independence score stamped on the side of the building. This was pretty much fudged And in the case of the United States was much too optimistic. You can see even in this data that the United States is an outlier. I mean, it's US researchers doing it, right? So they're trying to say, oh yeah, the Fed's pretty independent, it's pretty independent. But it actually over this time period had a higher inflation rate than its purported independence would suggest. And in reality, it was much less independent than assigned here in this study, and should be over closer to Canada rather than more independent than Japan and whatnot. You'll note Switzerland on here, very independent and pretty low inflation. Keep that in mind because we're going to talk about Switzerland later. And then, of course, this study was concluded when Germany still had the Bundesbank, its own central bank, which is simply or has more recently, been joined or folded into the ECB or the European Central Bank. So, what does the written U.S. Constitution say about the monetary system? Well, it says a bunch of stuff about states, that states shall not coin money, full-bodied money or fiduciary money. Full body meaning, with a silver or gold content close to what's stamped on the coin itself, or fiduciary, where you basically make a fiat currency out of a metal. It says that the state shall not issue bills of credit, which is the old-timey term for a fiat currency, be it a paper bill or an account entry. It says states shall not make anything but gold and silver a tender in payment of debts. In other words, a final legal payment in contracts, a way of fully paying off a bond or a mortgage or a promissory note, such that the legal system won't be used or can't be used against you to collect anymore. The fourth thing is a positive one. This gives Congress the power, quote, to coin money, regulate the value thereof, and a foreign coin, and fix the standard of weights and measures. This is one of many parts of the U.S. Constitution where it really helps to be an historian, and also to have a little bit of logic and common sense, and to do a lot of reading. But this strikes a lot of people as just very odd. Why would they put in standard of weights and measures right next to the power to coin money and regulate the value thereof? Well, the placement of the standard of weights and measures right there is the key to understanding the clause, though, because it wouldn't make any sense to empower Congress to say that $1 is equal to, say, 1 ounce of silver, but not also empower Congress to fix what weight an ounce is, or a grain, right? So it has to have both powers if it's to have any real power over regulating the value of money. What does the unwritten Constitution say about the monetary system? Now, I make this distinction because I'm writing a book about the New Deal, where I am making strong distinctions between our formal written Constitution and our informal unwritten Constitution. And I think it was the demise of the unwritten Constitution that allowed all of that crazy stuff to go on during the New Deal, particularly after the packing attempt and changes in SCOTUS and so forth. So clearly there was a precedent set in the colonial period and in the Articles of Confederation period during the American Revolution that the national government may issue a fiat currency if and only if, IFF, right? If and only if it cannot borrow enough to finance a crucial public good, like a war, like a Revolutionary War, or a second war for independence, or a war against breakaway states to preserve the Union, and so on and so forth. Unfortunately, that led to an understanding that was much more expansive than that. It was not if and only if they couldn't borrow, but an understanding that or belief that it was okay for the federal government to print permanent fiat money. And so SCOTUS is read, the power to coin money and regulate the value thereof is interpreted in a way that Hamilton and other founders and framers would find abhorrent, I believe, like the gold confiscation, during the New Deal, the abrogation of gold clauses that went along with that. And then, of course, since the early 1970s, this permanent fiat money regime that we have found ourselves entangled in. Now, Hamilton's argument for the constitutionality of the Bank of the United States was premised on the unwritten Constitution, I think, and the unwritten constitutional notion, quote, that every power vested in a government is in its nature sovereign and includes by force of the term a right to employ all the means requisite and fairly applicable to the attainment of the ends of such power. Now, those italics are his, and this is usually where statists end, because they like to misquote Hamilton on things like the national debt and on the necessary and proper clause and so forth. But if you continue reading, there are a couple of very important caveats that Hamilton adds to this, and which are not precluded by restrictions and exceptions specified in the Constitution. And what I think really holds for the Fed, or not immoral or not contrary to the essential ends of political society. Those are that's my bold-faced emphasis put on there. Not contrary to the essential ends of political society. Now, what would Hamilton have meant by that? Clearly, he would have meant the protection of life, liberty, and property. So the government can do what it needs to do in order to, the national government can do what it needs to do in order to fulfill, the powers that it has and have not been precluded to it or accepted from it as explicitly specified in the Constitution. But it can't do stuff that's immoral, and it can't do stuff that runs against the protection of life, liberty, and property. So I was just, shaking in my boots at Kevin Dowd's presentation earlier in this conference, where he was talking about central bank digital currencies and the major threat that they pose to our liberty. So Hamilton's argument in support of the constitutionality of the first bank of the United States could not be used to support a CBDC, because a CBDC is contrary to the essential ends of political society. It's contrary to the protection of our liberty. And also, Hamilton's argument for the constitutionality of the first bank could not apply to what Comfrey Murray Sabrin calls the sucky Federal Reserve. It could be used to support the creation of a new central bank with characteristics like those of the Bank of the United States, though, of course. Both of the institutions called the Bank of the United States, there was one that was in existence from 1791 to 1811, and a second that was in existence from 1816 to 1836. They were both they differed a little bit between themselves in terms of their size and so on and so forth, but they were both very different from the Federal Reserve. They were much more independent of the government than the Federal Reserve is. It would have been nearly impossible to get rid of either banks of the United States prior to their sunset provisions. You might know as they both ended after 20 years, and that's because there was a sunset provision built right into their charters, right into the laws that created them, that stipulated that they would only last 20 years unless renewed. Now, the Federal Reserve initially had a sunset clause in it, but later it was made perpetual, and that does make it a little bit more independent because it's there's not an automatic expiration date at which juncture Congress has to do something to keep it going. To get rid of the Fed, Congress is going to have to do something explicit. It's just not going to time out or sunset like a day. The banks of the United States control their own budgets like the Federal Reserve does, and that also gives them some independence. They don't have to go hat in hand to Congress to ask for appropriations. They were mostly privately owned by individual shareholders, not regulated member banks like the Federal Reserve is. The government, the national government, owned some shares in the Bank of the United States, both versions of it. But those shares were, could be, and in the case of the first bank, eventually were completely sold off to private shareholders. Their liabilities were not a legal tender. They issued notes, they issued deposits, they were both redeemable into gold and silver on demand. And nobody was forced to take a Bank of the United States note if he or she didn't want to, but they did. And I said she on purpose because one of the major avenues of my research has been to show that women were involved in the U.S. Financial system to a degree that amazes most people. The Bank of the United States, again, both versions, regulated state banks, but not in a top-down command and control way like the Federal Reserve does, by saying you must do this, you can't do that, here are the sanctions if you break them. They regulated the state banks using a market mechanism. They collected their notes and then redeemed them for gold and silver. And that made the state banks keep an eye on their reserves. So it's not like the Fed has an explicit reserve requirement that it's using the force of law. It's just by returning those notes to the state banks, it's putting the state banks on notice that if they issue too many notes, it could come back to haunt them and cause them to fail. So it was a market mechanism for regulating those banks, vastly different from the Fed. And also vastly different, and something I'll talk about in more detail in a few minutes, is that the banks of the United States functioned as a lender of last resort following Bagehot's rule, or what some of us have taken to call Hamilton's rule during financial panics. The third point, domestic monetary policy doesn't have to be activist. This table shows the history of the way that America has solved the macroeconomic trilemma. A trilemma is like a dilemma, but with three aspects. And the key insight is that monetary systems can only do two of three things simultaneously. The opportunity cost of doing those two things is that they can't do the third thing. The three major things are have an activist domestic monetary policy, have free international flow of capital, and fixed exchange rates. So different points in US history, we've had different solutions, solve this trade-off in different ways. And basically from the formation of the country until 1933, we were on a retail specie standard, and that means that we solved the trilemma in favor of fixed exchange rates and free international capital flows. So gold and silver, stocks and bonds are flowing in and out of America without any restriction. The US dollar is tied in known and stable ways, long-term stable ways, to the world's other major currencies like the British pound sterling and the French franc and so forth. The cost of that was that we could not have activist domestic monetary policy. That means that there was no way to change interest rates domestically or the domestic money supply in order to reduce output volatility. So we get some output going, going down for extended periods. And of course, the worst period of this was during the Great Depression, which is why in 1933, FDR and his minions in the New Deal decided to change things up to endow the Fed with activist domestic monetary policy powers, but they wanted to maintain the fixed exchange rates and the sort of illusion that we're still, I shouldn't say illusion, but to not break completely with tradition and move off from gold completely. So we're on two gold exchange standards, one in the interwar period, the Depression period, and then of course Bretton Woods for about a quarter century from the end of World War II up into the early 1970s. And these systems, there are fixed exchange rates, again, between like the US dollar and the British pound are stable, not as stable for as long as under the gold standard, but are stable for a period of years where there's not even 1% changes year to year in the exchange rate. And the Fed has some domestic monetary policy discretion to change interest rates and the money supply in order to combat recessions and so forth. The cost of that, though, was that there were capital controls in place. No longer is gold and silver or stocks and bonds flowing freely between the United States and other countries in the world. That has to be capped if fixed exchange rates are to be maintained and activist domestic monetary policy maintained. So in the 70s, we slide off, early 70s, we slide off gold completely and go on what's called the free float period. And that basically goes up to the present. And in that solution to the trilemma, we have dropped fixed exchange rates. And now we have very volatile exchange rates. You don't know from one day to the next how many how many pounds sterling or how many euro your dollar's going to buy. We return to free international flows of capital. Stocks and bonds can move across the U.S. border. Gold and silver and so on and so forth can move across the U.S. border freely once again. And the Fed retains the ability to change interest rates, change the money supply, and in this whole period, basically since the New Deal, saw the ascent of Keynesian theory, which Phil Magnus talked about in some detail in an earlier presentation for this conference. The rise of the dual mandate, where the Fed is supposed to both maximize employment and ensure price stability. So how do we end this domestic monetary policy discretion if we want to do so and move back to a different solution to the trilemma? Well, one thing we could do is adopt a hard rule, like the Taylor rule, and just say that the policy rate is going to be a function of the deviation from an inflation target and deviation from an output target, or a function of a deviation from a nominal GDP target. But as Larry Wright pointed out in last week's talk, how can the Fed be forced to follow such a rule? It has an incentive to water it down to a mere guideline. So it turns out we didn't have a 2% inflation rule. We had a 2% inflation target, and the Fed changes the goalposts in the middle of the game. And so we end up in the situation where we're close to double-digit inflation right now, as I'm sure you all know. We could try to create a new incentive-compatible central bank, more like the privately owned and traded Bank of the United States or the Swiss National Bank today. I'm surprised that I've talked to a number of monetary specialists, and they don't realize that the Swiss National Bank is privately traded. And it's, of course, has a reputation for having a pretty low inflation rate. It's currently 3%. And remember that study I showed you earlier on in the presentation, I pointed out Switzerland was one of the countries on the far right-hand side with a lot of independence for its central bank and low inflation, and that continues to hold. But we could probably get even more incentive compatible. Why not tie central bankers' salaries to short-term inflation and tie their retirement benefits to long-term inflation, and have somebody else measure it so they're not they're not cooking the books. New Zealand came closest to this. Remember, New Zealand was an outlier over on the left-hand side, high inflation rates in the 70s and 80s. Well, in the late 80s, it implemented a policy where it said it was going to dismiss its central banker if inflation got too high, and that helped it to regain some credibility in the 1990s. Other things we could do to end the Fed's reign over domestic monetary policy: we could peg the dollar price of gold. We could return to an international gold standard. We could devise a new commodity basket standard. We could try a crypto standard where the crypto supply curve, unlike Bitcoin, is not predetermined. Again, for details, see Larry White's talk from last week. We could allow full market competition in money issuance. We could put gold ownership on a blockchain and let it compete with other forms of private money. There are some private quote unquote mints now, like that producing the New Hampshire goldback. I don't know how well you can see that, but this is a paperish type of note that purports to be 1/1000th of a troy ounce of 24 karat gold. and it says on it, it's a voluntary negotiable instrument, right? So it doesn't purport to be legal tender. It just says, hey, if you want to use me, you know, you can trade me for goods. How would market competition in money work? Well, I'm an historian. I think it would work like it did in the old days when we had market competition in money. So you go into a store, you don't see posted prices. You ask, how much is this? And the answer was in the colonial period in British North America was, and what do you pay? And the answer would be different if you said you were paying in beaver pelts versus wampum versus copper versus Spanish silver versus the local colonies' bills of credit. And this was a royal pain, no pun intended, in the 1700s. But today, you know, presumably this would be much easier to do because you wouldn't have to ask a person. You could just go in with your phone and scan the barcode, and then it would you know, give you what you would need to tender, and a bunch of different things, maybe this or gold on a blockchain or US dollars or Swiss franc or what have you, in order to be able to lawfully acquire that asset. This is an example of a coin rating table from the colonial US in 1757. So this is different, it lists different coins and then their value in England, in Fluffia, and in New York. And the English ones are declared by English law, but the British decided that the colonies could no longer be trusted with rating coins locally. So they forbade the governments from doing it, but all that did was move it to the private sector. Usually consortium of merchants for each colony came up with the ratings. So an English sixpence in England was worth 6D, 6 pence. The D is the symbol for pence, S for shillings, L for pounds. There were 12 pence in a shilling and 20 shillings in a pound. So you see the English sixpence in England, of course, is worth 6 pence. But in Fluffia, it's worth 9 pence. And in New York, also 9 pence. The English crown, the French crown, worth 5 shillings in England, but in Philadelphia, 7 shillings, 6 pence. And in New York, 8 shillings. The guinea, of course, is 21 shillings. So 1 pound, one shilling in England. But in Fluffia, they rated it as 1 pound, 14 shillings. And in New York, 1 pound, 16 shillings. And so on and so forth with all of the major silver and gold coins in circulation in the transatlantic world. So yeah, and look, they're using pieces of paper and whatnot to do that. We can certainly figure out you know, similar mechanisms that would be entail much lower transaction costs. The fourth point is that there have been, can be, should be private lenders of last resort. So what do I mean by this? Well, when there's a financial panic, there is fear that there's not enough cash to go around. So all firms, even ones that are solid, they're solvent, that know they're solvent, will sell assets at low prices for whatever the lawful or current money is in that time and place. And of course, that leads to bidding down the prices of assets that causes some marginal firms now to be insolvent. and it basically leads to deeper output declines than is strictly economically necessary. So the solution that has come up is the lender of last resort. And this is an entity that supports prices during panic. So you don't get this downward spiral of fire sale prices leading to bankruptcies, leading to more fear, leading to more selling, leading to more bankruptcies and so forth. It's often thought that a lender of last resort is a public good, but lending during panics actually can be a profit opportunity for private entities, right? Just ask Warren Buffett. He knows all about this. Or it can be an opportunity for an assumed mutual risk between, say, banks or insurance companies, often coordinated by a nonprofit entity like a clearinghouse that has informational advantages. Now, the Federal Reserve acts as a lender of last resort by lending at a low rate, a low interest rate to any bank that wants cash during the panic. And that sounds great, but it causes what economists call moral hazard. It induces more risk taking on the part of banks because they know if they get into trouble that the Federal Reserve is going to be there and is going to make loans to them at low interest rates. And if the Federal Reserve acts as a lender of last resort for too long, keeps interest rates low for an extended period, it can lead to inflation like we're experiencing right now, which of course is partly caused by, the low interest rates that we had for over a decade after the global financial crisis in 2008. The Fed could, but does not follow Hamilton's or Bagehot's rule, which is the lender of last resort should lend at a penalty rate to all who can post sufficient collateral. By penalty rate, it's meant a rate that's higher than prior to the panic. Right? It might be less than the highest market rate that a lender might try to get during the panic. If there's any loans at all going on, there can also be a credit freeze where the panic market rates are merely nominal, right? But the lender of last resort comes in and does charge higher than the usual, and will lend to everyone, banks and non-banks ideally. But sometimes, like with the bank clearinghouses that took over the lender of last resort function after the Civil War, maybe just member banks, banks that are members of the Clearinghouse Association, in other words. And by sufficient collateral, we mean what was considered a prime security before the panic, at or near the pre-panic prices. So this Hamilton's rule or Bagehot's rule turns out to be a very effective rule in panics for this lender of last resort function, because solvent firms know that they can borrow if they have to, so they don't panic and start selling assets just to raise cash, just to have cash. Insolvent firms, on the other hand, don't have sufficient collateral, so they cannot borrow enough to keep them afloat, and they rightly fail, which is what, frankly, we want to happen during panics. So the moral hazards minimized by the penalty rate and by this risk of failure. It's that penalty rate that, of course, is an inducement for private lenders to step in during crises and to make loans. And the other thing that it does is that Hamilton's rule does is it does not cause a massive forced redistribution of wealth to occur like often happens after crises. Most recently, after the global financial crisis of 2008. So I added a book called Bailouts, Public Money, Private Profit, that details the different types of bailouts that have occurred over US history, and who has taken on the risk and who profits from it. And what the really bad situation is implied by the subtitle here, is when there are private entities that are profiting from the bailouts, and public money is being used to make the bailout. So you can get the book or look at the video for the details on this. I see I'm running out of time here, but the key point in terms of the discussion of ending the Fed is that if you have a lender of last resort that's private, and they're following Hamilton or Bagehot's rule, risk is not socialized, right? The risk is being undertaken by the clearinghouse, by the Bank of the United States, by some other private, like a Warren Buffett or a JP Morgan, stepping into the lurch and buying simply because prices are so good or the interest rate is so good, given the collateral that can be posted. So summing up, the Federal Reserve is unnecessary and improper. It's unnecessary because it's a creature of statute, not fundamental law, not natural rights. It's also unnecessary because, unlike the Bank of the United States, the Fed is not clearly constitutional, especially during its pure fiat phase post the U.S. going off from gold in the early 1970s. It's improper because discretionary domestic monetary policy privileges output stability over the free international flow of capital or exchange rate stability, and because private lenders of last resort have worked in the past and have been more likely to minimize inflation, to minimize moral hazard, and socialization of risk than government lenders of last resort like the Fed. Thank you so much, and I look forward to your questions.
Okay, thanks for that great presentation, Robert. It's absolutely excellent. Let me start out with a couple of questions of my own. It's never been real clear to me what the difference is between the Bank of the United States and the Federal Reserve. Can you kind of summarize for us what the difference between those two institutions is?
Yeah, well, the Bank of the United States, there were two banks of the United States. They were early 19th century. They were privately owned. They followed Hamilton's rule, and they sunsetted out of existence. And then the U.S. didn't have a central bank from 1836 until the Federal Reserve becomes operational in 1914. Federal Reserve is a completely new institution, built differently from the ground up, is owned by member banks, doesn't have publicly traded stock, and does not follow Hamilton or Bagehot's rule.
And did the Bank of the U.S. do the same sorts of things as the Fed does?
No, it was under a gold standard. The only way that it regulated other banks was by returning their notes to them.
Okay.
It didn't say you have to have a reserve requirement of 15% or there are going to be legal sanctions against you. It simply collected their notes and checks and whatnot, their liabilities, and presented them at the bank and said, "Give us the gold and silver that we're due, please." And that was enough generally to keep the state banks in line, because they knew that there was this institution out there that was going to show up with a bunch of their notes and ask for gold and silver. So they better keep enough in the vault.
And so was there any big effect when the Bank of the U.S. was sunsetted and it goes out of existence?
Oh yeah, no. I mean, the first one goes out, you know, a year later, we have the War of 1812 starting, and we don't have an easy place for the federal government to go to borrow. So the federal government at times issued you know, form of fiat paper money during the War of 1812. And then after the second bank sunsets, that's the infamous fight between Andrew Jackson and Nicholas Biddle. There's a severe financial crisis that occurs, but there were no private lenders of last resort that had yet arisen to fill the spot left by the second bank of the United States. So we had actually a series of financial panics, one in 37 and one in 39, and a depression that lasted until 1843. That was pretty severe.
Okay, another question. There was, throughout the 19th century, there was a fixed exchange rate between gold and silver, and which were being minted, of course, by the U.S. Mint, issued by the U.S. government. What would have happened, or do you think they would have been better off not having a fixed exchange rate, even though the government was issuing the currency? Just let the market determine the exchange rate between gold and silver?
Well, I mean, all it means basically is that you're going to get a circulation that's all gold or all silver, right? So essentially, the market does speak in that situation. So, and I'm not, you know, because that ratio does change over time. It's not clear who would have made the determination and how that would have changed, you know, especially without a central bank. So, you know, bimetallism is tricky, and you know, I think we were better off later on when we just said gold is the thing, but I mean, we got by just fine under the, you know, bimetallism.
Okay, and the last question I have is, and if anybody has a question, we don't have any questions in the hopper. If anybody has a question, you got to use the Q&A button. I think everybody knows it all by now after attending this conference. Do you think it's possible? I mean, we have the FDIC to protect in case of protect depositors in case one or two or three or four banks go under. But do you think it's possible to have an industry-wide banking crisis where a lot of banks are going under and the FDIC can't cover everybody?
Yeah, it's absolutely possible, and it's possible because of the existence of the FDIC itself. The FDIC, you know, raises moral hazard, right? It used to be that depositors paid attention to their banks and what their banks were doing, especially major depositors, and they would move their funds if they thought that their bank was taking on too much risk, because any losses by the bank would be felt by them, you know, as depositors ultimately. But with the FDIC, there's no longer that incentive to monitor, you know, what banks are doing, and so they can take on more. They can take on more risk without having deposit withdrawals, you know, or a market mechanism. In other words, to chastise them. The best that you could get would be, you know, a decline in equity prices and share prices, but that cuts both ways on the shareholder side, right? Because shareholders sometimes want the bankers taking on more risks because there's a possibility for higher profits. Depositors don't want that, because depositors are just getting their contractual, you know, interest rate on their NCDs or CDs or what have you. So they don't want the banks taking on undue risk, unless there's a deposit insurance scheme in place, like the FDIC. Then they don't care. You know, they have these things called broker deposits, where they you know, very wealthy people break up their cash deposits and spread them over multiple institutions, so that all of their deposits are are FDIC insured. So there's nobody, unlike the old days, paying attention to, hey, why is this bank paying 12% interest when most other banks are only paying 6%, right? Right now, all that money floods into that 12% paying bank, even though it's pretty obvious that the only reason that they're paying 12% is because they're taking on a lot of risk or they're very desperate, right? So you don't get that market discipline when you have a deposit insurance scheme in place.
Well, and the fact that they've raised the insurance from 100,000 to 250,000 is concerning as far as I'm concerned, because I don't know, it kind of reveals that they want to keep everybody assured that everything's fine.
Yeah, that's correct. And that was supposed to be a temporary measure during the global financial crisis of 2008. Well, that crisis has come and gone, and they did not lower the $250,000 limit. Now, on the other hand, especially with inflation the way it is now, you could look at it simply as an inflation adjustment.
Right. Well, as a follow-up to what you were saying a minute ago, though, I don't know of any bank in the last 30 years, I'm sure there are, I don't keep track of everything, but I haven't heard of one bank that's gone under. All you hear is, oh, that bank has now been absorbed by another bank. But do you know of any banks? Have you heard any that have actually just gone under and not
Lehman
absorbed?
Brothers.
Oh, that's not a real bank, though, is it?
Yeah, no, that was part of the fallout from the savings and loan crisis, where there was pressure put on the FDIC and the dismantling of FSLIC, as it used to be called, the Federal Savings and Loan Insurance Corporation, which utterly and completely failed to stop the S&L crisis, where they're supposed to resolve banks before they go completely bankrupt, which, by the way, is the private solution to banks taking on risk and all of that, is to have multiple I'm blanking on the multiples, double or triple liability for shareholders. Right? So you're responsible not just for your shares, but twice your shares or 3 times your shares, and a credible commitment to actually going after stockholders, because then stockholders pay very close attention to what bankers are doing, because not only would they lose whatever they paid for their shares, but multiples of that. So it really increases shareholder monitoring of banker risk taking, and is a private solution instead of going to the government and expecting somebody with no skin in the game to make the right decisions.
Okay, on that note, we don't have any questions in the hopper. We'll wrap things up. Fantastic presentation, Robert. Thank you very much. You've helped make this conference, continue to make this conference really a great one. Thank you all for tuning in. Please take a look at our fundraising letter. We greatly appreciate your support. Like I say, we can't do it without those of you that help us out in a bigger way, and we be most appreciative if you take a look at it and give us your consideration on our website at fff.org. Next week, we have Ron Paul, or as he's known in the Libertarian movement, the great Ron Paul, the guy that actually popularized the phrase in America, all across America, of end the Fed. So Ron's one of my real life heroes. It's going to be a real honor and pleasure to have him here. You're not going to want to miss Ron Paul talking about ending inflation and the Fed, I guarantee you. Thank you so much for tuning in, Robert. Thank you again for a great presentation. It's been an honor and a pleasure to have you.
Thank you.